Hi, this is Natalie Pace. Yesterday, July 31st, 2024, Jerome Powell signaled that they may be cutting interest rates by 25 basis points at the September meeting. Now, today, the Dow Jones Industrial Average dropped almost 500 points. Will that continue to happen? What is your best strategy for both stocks and bonds? And how will this affect real estate going forward? We're going to talk about all of these various things and how you should position yourself, why they're cutting rates, which indicates how we should position ourselves. Remember also that we always want to hear from you. So be sure to email us at info@nataliepace.com. We want to hear about your money triumphs, your money challenges. We've been helping people and celebrating people since 1999. Also, visit nataliepace.com because there's many opportunities to deepen your wisdom and learn the life math that we all should have really received in high school and college so that we can be the boss of our money. Now is the time to, really make sure that we have an age appropriate, properly diversified portfolio, that the safe side is not experiencing paper losses that may actually turn into real losses. And even that we are in a position to live in a home that we can live in for the next 10 years, that we can afford, that we love, that's our sanctuary. So all this is things that we cover and have been covering for over 20 years now. So again, visit nataliepace.com. Join us for our October 18th through 20 Financial Freedom Retreat. It's online. You can join us anywhere in your pajamas. We have a bond masterclass. So if you're 50 or above that, even if you're not, and you want to earn a 5% yield safely on the safe side, join us for that. You do need to attend the retreat first, however, and it is the Saturday after our October retreat. All right, we'll get started with this video conference in just a moment. And thanks for joining me. Again, Natalie Pace.
Hey everyone. So thanks again for joining me and let's jump right in. So it's interesting because everybody has been waiting for this magical rate cut. And the minute that the FOMC says, yeah, that might be on the table in September. By the way, it's not assured, right? So this is an important thing for us to realize that it still is data dependent. And we'll talk about that going forward. But I think one of the most important things to note is that, yesterday when the market started, they were excited. And then when they started listening that there was this potential rate cut, about 2:45, you saw the sellers drive up the truck and start selling, selling, selling. And so there was muted returns yesterday. And then today, of course, there was a big sell-off with the Dow going down almost 500 points. So here are some of the things that we're going to talk about in today's conference. So first of all, we're going to talk about the signal and whether or not it's going to be 25 or 50. I guess you can see there it's not 50, but I'll tell you why. We're going to talk about why things are still data dependent. We're going to take a peek into Apple and Amazon earnings. They just announced today after the markets closed. I took a quick peek. Why are the Feds considering a cut? This is important. What does it mean for stocks and bonds? And then, of course, your best strategy for stocks, and then your best strategy for bonds. So, for Jerome Powell, yesterday was a very lively press conference. He was a little more relaxed than normal. He went off script a little more than normal. Normally, he has his talking points and he just drives them home. Everything leads right back to the talking point, and that's where it goes. But we did see a couple of the journalists yesterday were able to get a few things out of him that normally he would have kept, honestly, probably closer to his hip. So first thing he said was that they have not at all been discussing a 50-point basis point cut. So for those of you that care about that, even though the CME Fed Watch is saying 20% of the futures market is saying, oh, it's going to be a 50-point basis, rate cut. It's more likely, if there is one, to be 25 basis points. Now, also, why is why is the data so important, right? And the reason is their dual mandate is obviously maximum employment and price stability. Price stability means the prices shouldn't have been so high as they had gotten last year. So they had to make policy, they had to raise the rates, they call that tighten up, and make that the policy stance very tight, right? So it puts the screws on people. They can't buy as much and things of that nature. And the point is to stop, to basically slow things down and let prices go back down to where they should be. Now, of course, it's not going to make prices go down. It just means they won't continue going up as robustly, right? Because they still want to have a 2% year over year in inflation growth. That's about where they like to be. Right now, it's about 2.5%. Now, because I don't want to get you too far in the weeds of all these statistics, but what we know is that the policy is something that happens, and then it's lagging behind is what the effect of that policy is on the market. So if they see that inflation is down to 2.5 and that it actually has fallen a little bit, last quarter they were concerned more about it, right? It wasn't falling, it was actually increasing again. So last quarter, the pause was totally expected. This time the data looked a little bit better. So what they're saying is, hey, we don't have enough confidence that prices are stabilizing yet in order for us to cut the interest rate, because when they cut the interest rate, then they do run a risk that prices can increase more. So that is the risk there. And that's why they've been very focused on inflation, because inflation was the big problem. Now, what we're seeing is, even though they're saying the labor market is normalizing. So they said it was overheated before. There were so many shortage of people that raises were going up, and it was just a hard market because of the labor shortage. There are reasons for that have to do with inflation, but we're basically going to talk about the federal policy and how that's going to affect your nest egg. So basically, when we start to see that there's higher unemployment, even though it's only incremental, it's still very low, 4.1%, then they do start to have to watch that now, right? Before, it was the story was all inflation. Inflation was too high, and unemployment was historically low, so they had to work harder on inflation. Now that unemployment is ticking up a little bit, they are going to have to start looking at that. And what their tool is typically to help make sure that the employment remains maximum, so as many people that want jobs can have them, is they will start cutting rates if the unemployment gets too high. Typically, that's because we're in a recession. Now, we've avoided that, right? And it's not expected to happen this year, but they do have to watch it. So the thing that is data dependent that will indicate whether or not we get a rate cut in September, or a pause, or even potentially a rate hike, although that's less likely, is, will the inflation continue to show that it's going down? And will unemployment continue to show that it's going up? Hopefully not too severely. So that is the reason why there is a rate cut on the table, is that we did see in the most recent data that unemployment was creeping up and inflation was creeping down. And that means they can start reducing the restrictions on money. Now, a couple of other things that we should talk about before we jump into stocks and bonds and what you should be doing for yourself. First of all, Apple and Amazon. So they did report, and the report was pretty good. However, not fantastic, but pretty good. Like Apple, the earnings were up 5%. Net income was even higher than that. Amazon, I think their net income almost doubled, and their revenue was up 10%. So they really looked good. And yet, what was really interesting about this is that we are still seeing selling after they, so I told you that they reported their earnings after the markets closed. And this is the after hours trading that's provided by the NASDAQ. And you can see that Amazon is still being sold in the after hours, as is Apple, even though they had reasonable earnings reports. So the question is, why is that happening, right? And the main reason for that is going to be have a lot to do with this one right here, the CAPE ratio. So as you can see, stock prices are really elevated. So this is a CAPE ratio, and as you can see here, it's the blue line. So it's this one right here at 34. This is from July. And the only time this is even high, stocks are more expensive. You heard in the Great Depression that stocks just got too expensive, right? And they're more expensive now than they were then. And the only time in history that they were higher was in the dot-com recession. And that is when dot-com stocks lost 78% and took 15 years to recover. So the whales of Wall Street, which always move first, Main Street is always last to move. Oftentimes after 35% or more losses in stocks is when, we get the memo. So the whales of Wall Street know that stocks are overpriced and they're doing a lot of profit taking right now. They're also moving into small caps, which is interesting because in July, small caps performed at almost 11%, whereas the big caps were, I think, a little over 1%. And of course, it was that we were hitting all-time highs at the beginning of July, and then we've been seeing a little bit weaker performance since then. So if we go back to other things that we want to be thinking about. So the Feds, why are the Feds considering a cut? I just told you it's because inflation is starting to look like it's coming down. They know the policy is forward leading, and that the results of their policy, lags what they do. So they are anticipating that their tight monetary policy is going to keep inflation ticking down to its 2% goal. And also unemployment is moving up. Now, what does it mean for stocks and bonds? So the first thing is with stocks, whenever we see high unemployment, we start to see stocks going down. So high unemployment is commonly associated with recession. Recessions are commonly associated with stocks dropping. So in the dot-com, I just told you, NASDAQ composite index from the March 2000 high to the October 2002 low dropped 78%, and it took 15 years to come back to that same March of 2000 high. In the Dow, in the Great Recession, the Dow dropped 55%, and it took about 7.5 years to come back. And then in the pandemic, we saw stocks drop almost 40% in 1 month. In 1 month. So that's why you really have to be ahead of things, right? You want to be ahead of the recession. You don't want to wait for the headlines because then chances are you're closer to the bottom than you are to the top. Right now, even though stocks have started to recede a little bit, we're still trading very close to an all-time high. So if we do our rebalancing right now and we capture gains, we make sure we're age appropriate, and our sample pie charts, we're actually overweighting 20% safe, we're actually selling high. Right. And again, it's not all or nothing. It's not sell everything and then move into, 5% short-term T-bills. It's not that. You still want to keep, that age appropriate. So keep a percent equal to your age safe, maybe add up to 20% additional safe if there could be a recession on the horizon. Not predicted for this year, but it could come. Yeah, so again, this is a really good time to be rebalancing. In terms of bonds, the interesting thing here is that a lot of, especially as you know, I do a lot of second opinions. So a lot of the people that I, talk to and do second opinions on, they'll show paper losses on their portfolio on the bond side. And that is because bonds lost more than stocks did in 2022. They lost 26%. bonds, the safe side's not supposed to lose your principal. So now, you're going to be told that they were only paper losses and you're earning a 7% gain. But when you factor in the losses, you might not be earning any gains at all, and you might actually be losing money. And of course, they aren't necessarily just paper losses, right? Because they'll say, oh, well, you're going to get your money back at term. But I look at a lot of these terms, some of them are 40 years. Are you even going to live that long, right? Other things too is that the longer the term, the more likely that those distressed companies may have to restructure their debt. You're a debt, you're holding some of their debt in your bond. And that might mean that you have to, actually, those are not paper losses. They might be real losses, and it might be even more than what you're already experiencing. So I do want to remind everybody that, since the Great Recession, we've been saying, look, with interest rates at rock bottom, you're not getting paid to take on the risk of bonds, especially since the long-term bonds were so popular. At that time, probably between 2009 and maybe 2015, 2016, we were saying, lean into real estate, which of course was a great plan. Now, real estate's at an all-time high, so you have to be a little concerned about that. It's not just the simple math of whether or not, the home is more affordable than the renting is. It usually isn't. People are forgetting to add in quite a few things if they think it is. But you also have to worry about, if you're buying high, if the value drops, that you could actually have an underwater mortgage. And those people that say that real estate never drops, they either did not live through the Great Recession or they're willfully forgetting it because, some markets they dropped way more than 50%, but a lot of markets they did drop by half. So I think it's just important for us to be the boss of our money, to know exactly what we own and why. On the bond side, I would keep the term short, the credit worthiness high. I might go out to a 2-year duration. I would even be a little nervous about a 5-year duration. You might ask me why, and that is because over half of the S&P 500 is at or near junk bond status. There's just too much debt in the world, and that's why. Also, I would observe FDIC insurance levels. On the safe side, I wouldn't have everything in just one thing. I wouldn't have it all in T-bills. I wouldn't have it all in one bank. I would, really also want to have what I call rolling maturities. So I always had access to my money because I think perhaps the most important thing is that if there is eventually a recession, we've had a very strong economy that's been surprising everybody, right? But if there is indeed a recession, whether it's 6 months from now or a year from now or sooner, those people that have money that didn't go down in value, they have liquidity, are the ones that are able to buy low, right? So that's why it's super important for us not to be reaching for yield or extending the duration too long. Is that, we could have paper losses. Paper losses mean that if you want to actually access that money, you're going to have to turn those paper losses into real losses by selling. So that's what I would say is that on the at-risk side, the stock side, let's do your rebalancing now. Let's be age appropriate. Let's make sure, I again in sample pie charts, I'm overweighting safe. And on the bond side, keep the term short and the credit worthiness high, have rolling maturity dates. And get yourself in an emotional place where if the economy goes down, instead of thinking that we're in the apocalypse, that you're ready to start buying low. And that's hard to do because it always feels very, very vulnerable in the recession. And that's largely to do with the fact that people lose too much money. So when you don't, I must say, I did have a lot of people send, some people even with almost tears in their eyes were sending us love notes during the pandemic because when everybody else saw their portfolio drop by 35, 38, 40%, oh, in less than 1 month, they had enough safe. And, like if you're 50 and you're overweighting 20% safe, you have 30% at risk. So that's only going to go down by maybe 10%. Whereas if your whole thing is in stocks and it goes down, your $1 million goes down to 650,000, that's going to feel very vulnerable for you. So there's one other thing that I wanted to address, and this was a question that came in, and this one was about taxes. And what I'm assuming is that this person is deciding that they want to be the boss of their money and they want to self-direct, and they are moving out of a managed plan. So what I'm guessing is happening is that perhaps their person that's managing their plan is saying, "Oh, well, who's going to give you tax advice, right?" And that's where I want to remind you about what it is like to be the boss of your money. So all of these financial professionals have different roles to play. Your broker salesman, actually, they aren't even hired as analysts, they're hired as salesmen, but they're there to help you with stocks and bonds. They don't do taxes. They don't know about taxes. The only thing that they know about taxes are what they're told to sell or talk about when they're making the sales pitch. So, who does know about taxes? That is an accountant or the IRS.gov website. But I will also give you a couple of other tips. The first thing is I put my hot slices in my Roth. And the reason for that is that is the first of all, any retirement account, if you have your stock positions in there, even your bonds too, but especially stocks because they go up at a higher rate than bonds, then you don't pay capital gains taxes on it. The additional benefit of the Roth is that you're not going to pay income tax on it, right? So if that one, you have your shoot the mooners in there and it increases at a much faster clip, then when you start pulling it out, you're not going to have to pay income tax in addition to the fact that you didn't pay capital gains taxes. So I would say that having, understanding that your best tax protection is actually the tax protected retirement accounts themselves, and getting smart about where you're putting various different assets and that's probably not something that the broker salesman is helping you with. The other thing that I would say about taxes is that IRS.gov, whatever tax thing that you might be interested in, you can Google it and you can find out great things like health savings accounts, which if you're healthy and spending an arm and a leg on health insurance and you're pre-Medicare, then this is a no-brainer. It's going to save you thousands, if not tens of thousands of dollars annually in your budget. You get a tax credit, so you stop making the tax man rich. So there's a lot of tax things that a broker salesman won't even tell you. What they're going to try to do is use that tax argument to sell you tax-free muni bonds or something like that. The last thing I'm going to say about taxes is that Peter Thiel, who's a famous billionaire, reportedly, according to ProPublica, has about $5 billion in his Roth IRA. Now, the Roth is the one that has that annual limit on it. Now, he may have used a backdoor and paid some, taxes on it initially, but the real thing here is that he was original founder of PayPal. He was an original investor in Meta, which was Facebook at the time. So, he was always getting stocks and options, and he was probably putting them in the Roth, knowing that those were the shoot the mooners that could go up more, right? So over the course of 20 years, the power of compounding gains on shoot the moon stocks can be powerful. You're probably not going to become a billionaire, although maybe you will. But anyway, so that's my spiel on taxes. Now, before I wrap things up, I'll go ahead and stop here. I don't have a lot of time for questions today, but we'll take a few if you guys have a question or two. Let me just pause. Sorry, there's one more thing I want to say before I pause and take questions. That was a blog that I've been referring to, and I do plan on posting that at nataliepace.com/blog within the next 48 hours. So you'll be able to read additional information on the things that we discussed in this video conference, and also link to other articles and other blogs that take some of those things a little deeper. Okay. Okay, so the first question was about some individual stocks that this person has, and she has mentioned NEO and C3. So the first thing is NEO. I actually did a blog on it recently. So the interesting thing, which I see, especially in newbie neophyte investors, is that we always really notice the losses, and it's like, oh no, that must be bad. Maybe I better sell it, right? What you really want to do, whether it's gains or losses or whatever, is you always want to, if it's an individual stock, redo the stock report card. If you've taken my stock master classes, then you need to look at the forward guidance. You need to listen to the earnings calls. So you want to know what's coming down the pike. But I'll give you the headlines on NEO because I just did the blog, and I'll go ahead and put the blog in the video conference, and I'll put it in our chat as well. So NEO is actually doing really well. It's selling a lot more cars, but it also is not able to sell in Europe because Europe did tariffs or the US. So that's a little bit of a block, but it's selling most of its cars in Asia and in China anyway, and it's doing quite well. The big problem with US, which is probably not showing up as much in Asia, is that US investors are not interested anymore in Chinese equities. And the Index of Economic Freedom has called China repressed. And so people are just saying, hey, I'm not going to invest there anymore. So that's where you're having the problems, is that NEO is actually doing really well as a company. It's selling a lot more cars. I think it doubled revenue in the most recent quarter. But investors are just not super thrilled with China. Now with C3, I can only give you like the 10-second analysis on that one. Let's just take, but you should definitely take it deeper. So with regard to NEO, maybe I don't, when I'm doing my rebalancing, I don't think it's helpful for me to say I lost money on this, I won money on that, right? That makes it feel like Vegas. What I do is I look at my portfolio and I say, here I am. And what do I think is going to perform the best for me going forward until my next rebalancing session? The other thing I would do is that, we get excited when we first start this process about individual stocks, but they require a lot of babysitting and a lot of research that funds do not require. So it might be appropriate if you're not willing to do stock report cards and babysit. And babysitting does not mean watch the price. Did the price go up today? Did the price go down today? That is not going to be helpful in determining whether or not you need to sell it, because if investors love China and they see that it's doubled its sales, then they'll all want to buy it, and that'll push this price up. But you're now seeing what the problem is with NEO, is that it is doing much better. And it's just having an issue because US investors are pretty sour on Chinese equities. So let's take a quick look. Hold on one second. By the way, I do want to show you this real quickly. I guess we can come back to it. But you're getting paid more for a shorter duration on bonds. It's still an inverted yield curve. So as you can see here, if you wanted to do a 30-year treasury, you get 4.3%. If you want to do a 6-month, you get 5%, right? So you're not getting paid to take on the risk, the higher risk. So let's take a look at C3, if I can find it. C3AI. So this one is a small cap, right? Let's just take a quick look at the analysis, and then we'll also take a quick look to see what country it's based out of. So the growth rate is okay, but like if we were to compare this to NVIDIA's growth rate would be 200%. This is 20%. So that's probably one of the issues right there, is that this is an explosive industry. And it's based out of Redwood. So again, what you really need to do on C3 is you need to look at the forward outlook. You need to listen to their earnings calls, and maybe they see if they've got a new client or not. Did they lose a client? Like, why did people sell off? So you want to know the story behind it. And that's going to help you to decide, is C3 my best investment going forward or not? Okay, I'm going to stop it there for a moment. Well, actually, let me make sure, because I did pull up a few charts and things that I wanted to show you before we end our little time together. So this is the SEP. I will be showing you guys this. I'll have a link to it in the comments section of this video conference. So it shows you, what they think that GDP is going to be this year, which is about 2.1. And again, the longer run on interest rates, which is something I'm going to mention in the blog, is expected to be 2.8%. That's not nearly as low as it went in the Great Recession, when it went down to 0, right? So those of you that are in real estate, you may know that this is going to have implications for you as well. So those 3% mortgage rates are over and done, which has got a lot to do with why people don't want to move out of their house and their 3% fixed rate. Apple earnings. Let's see if there's anything else here. Yeah, so I'll be putting in a few of the blogs. And the other quick thing I wanted to show you, there's the asset bubble chart. So again, that's why we're living in a debt world. Over half of the S&P 500 is at or near junk status, including a lot of banks. And that's just all playing into why, especially on the bond side, keep the term short, the credit worthiness high, observe FDIC insured levels, don't put everything in one thing, and have rolling maturity dates. Of course, we're going to talk about this all day long on day 3 of our October 18th through 2024 online financial freedom retreat. And then we're going to have a bond masterclass the following Saturday that's going to talk and go even deeper on it. Okay, so thank you guys so much for joining me today. Remember, if you are a volunteer, that you can always email questions, right? And I'll answer them, a question or two in our monthly video conferences if you're an active volunteer. So again, thank you so much. Be sure to follow me on Instagram at instagram.com/Natalie Wynne Pace. That's my middle name, Wynne. And on Substack, Natalie Pace, on YouTube, Natalie Pace, so that you can watch these back and you're not going to miss anything. Yeah, so it looks like we might be entering a new kind of period here. All right, I'll just see you. I'm not positive whether or not we'll do another video conference in August. I'm actually updating the ABCs of Money 6th edition. That's the highest priority. I want to get that published hopefully within the next 30 days, so watch for that as well. And we probably will have another summer sweepstakes to help support and get reviews for the new ABCs of Money. So thanks again, and I'll see you guys soon.